Okay, away we go. Welcome to 15 Minutes to the Bell with Carson Investment Research. Hopefully people start joining here. There we go. There's some people joining. We've got Jim Paulson today. So excited. And Sonu's going to join here in a minute or two. Hopefully everybody hears me. I do have a new phone. So first time I've done this with a new phone, assuming everyone hears me and it's working just fine. There's Sonu. I'm going to approve you, Sonu. All right, Sonu, I do need to read the disclosures. Would you hear me loud and clear on this new phone?
Hey, Ryan. Good morning.
Good morning. I sound okay? I got a new phone.
Yes.
Okay.
Oh, nice. Yes. Perfect.
Yeah,
Great.
yeah. So, yeah, all right, good. So let me read the disclosures, and then hopefully Jim will join here in a minute or two, and away. There is Jim. There's Jim. I'm going to invite you to speak, Jim. Let me read disclosures. All right, Jim, you should be able to speak here in a minute, Jim. I'll read disclosures first. Investment advisory services offered through CWM LLC, an SEC registered investment advisor. This recording is for informational purposes only, is intended for an audience of financial professionals, and should not be copied or reproduced without the consent of CWM LLC. This is Jim's line. Guest presenters of our show are not affiliated with CWM LLC. Opinions expressed by these presenters may not represent or may not be representative of CWM LLC. So this is Jim's first time doing a Spaces. Jim, I hope you hear us. Say something. Let's see if this works.
Hey, Jim.
Uh-oh.
He may be on mute.
Jim, maybe on mute, maybe. I don't know. I gave you permission to speak.
Unless his computer is doing the same thing mine did this morning.
Well, hopefully it's on his phone. Should just be on his phone. I don't know. This Jim Paulson is speaking, but I don't hear him, right? You don't hear him, right, Sonia?
I don't hear him either. No.
Huh. Well, we've had a little snag in the world today. Jim, we don't hear you.
It is be the on morning your phone for speaker. Snags, I can tell you that. Yeah. I'm just amazed that, we're expecting AI to solve the world and all that, and we can't figure out how to update a computer without turning the damn thing off.
Yeah, Sonu turned his computer yesterday. I turned my computer on, and we had a call with our advisors, our partners, and it just made me, do an update, and I couldn't do anything about it, so I was late. And you've been in update heaven, hell, whatever you're gonna call it.
I know.
We won't say the other word. That happens sometimes. So let's see here. So, Jim, I'm not sure what to say. Maybe send me a DM, Jim, but we're not the biggest tech people. Usually this works. I don't know. I mean, Sonu, we can just start talking. I hope we can get Jim's voice to come. Let's see here. Let's see here. Well, Sonu, let's just start with inflation. How about you talk about inflation? We'll work with Jim here and hopefully get this to work. I saw PPI came in a little better. What'd you think?
Yeah, I mean, you combine PPI with PPI is important from the perspective. Two things, right? PPI is important from the perspective of how it adds to CPI, like several things, airfares, medical services, all of that. For PCE, it comes from the PPI data. It's not what shows up in CPI. So CPI in some of these areas can look quite hot, and it did, like airfares, medical services, like quirky things could happen, right? But then PPI showed a much more benign number, so we're still on track. That the big picture is, look, inflation's normalized, right? Like yesterday, everyone was like, "Oh my God, it came in hot." 0.2% headline, which is above the 0.1% expected. 0.3% core, above the 0.2% expected. But is inflation heating up again? Look, guys, this is normal, right? And like, you go back, and I'll have a chart on my blog on this for today, showing monthly data, core CPI and headline CPI, every month between 2017 and 2019. What we're seeing now is, we've seen this before, right? Even headline CPI of 0.2% between 2017 and February 2020, before the pandemic, 18 out of 36 months, half the time, CPI came in above 0.2% month over month. So yeah, inflation's normalized. The other thing for PPI I like looking at is margins. So PPI, as most people think, and this is true to an extent, that it is what businesses pay, right? It's producer prices for the inputs that they take in for their production processes, things like that, both on the goods and services side. But there's also for wholesalers and retailers, PPI actually measures margins. And, I've written about this in the past. And the good news is, look, back in 2022, early 22, PPI for trade services, basically the increase in margins, it was rising at 19% year over year. That was a big part of that inflation increase. Right now, Ryan, that's at 1.6%. That's pretty much where we were before the pandemic. It's normalized. So all this to say, the inflation numbers are okay.
Okay, well, good. That's kind of what I figured. Yesterday, CPI freaked out some people a little bit. So, not so soon. I forget where I was. I was on some media platform, and I said the Master Yoda line: one data point a trend does not make. This is 1 month of a little bit hotter inflation, but we're not overly concerned yet. So, Jim, we'll just talk. 'Cause I know you can hear us. I took you away from being a speaker, Jim. You should be able to request to speak. Hopefully, Jim, you see how to do that. You can just invite to speak, and I can approve it, and then maybe we can hear you, Jim. But if this doesn't work, it doesn't work. And sorry about this. I know everybody came to see Jim. We should just turn it off. So I came to listen to Jim.
I wanted to hear more about the market broadening out, and it's taken.
I know.
About that recently.
Well, yeah, exactly.
But I
well,
can just ask you instead about.
Yep. Go ahead. Mm-hmm.
No, I'll just ask you about what we've seen this week so far with respect to. I mean, more record highs, right? I mean, yesterday is a little bit of a pullback, but that's just noise, right? Let's just be clear. But day before, yet another record high for the Dow and S&P 500, right?
No, exactly. On Wednesday, and Jim, I did just send you the invite to speak again. I mean, no, you're not there. Let's see here. I'm trying this. Okay, so Jim, you are a speaker. Try it one more time, Jim. Let's just give it the old college try.
Am I?
Oh my goodness! Oh my goodness, Jim! We have Jim Paulson. We did it, Jim. Funny. Jim, I go on TV all the time like you. I never get nervous. I literally was nervous. For the first time in 2 decades, I was nervous.
Ryan, that's what you get for asking an old dog.
I didn't want to talk too bad about you until you made it. Now we can talk bad about you.
I told you last night on DM that
I know.
I just joined X in February, and this dog is not used to spaces yet. So thanks for bringing me into the new era.
You know what? You made it. I don't know why it didn't work earlier. I'm not even going to worry about it. We hear you loud and clear, Jim. It's an honor. Sonu and I are so excited. I know we've mentioned this a while ago. Let's just start high level. You are an icon in the industry, someone I've looked up to for decades. Honestly, you probably don't realize it, but I've watched you from afar. And honestly, I've taken some of the way you do things. Just to be honest, when you're on TV and they say, "Hey, Jim, what do you think of the stock market?" You look at the TV, you smile, and you say, "Thanks for having me." Not all guests. I mean, seriously, not all guests do that. And I saw you do that decades ago. Like, wow, that's kind of cool. So I do that. You're very calm. And of course, it's nerve wracking. You're on TV, but you don't show it. And I've taken a lot from you. So I just want you to know that. And I'm just honored that you're here. You kind of retired you got it. So you kind of retired for a minute and then you came back. Talk to us about why you came back. You couldn't stay away, could you?
No, I didn't think I have retired, and I still figure myself being retired, to tell you the truth. But I guess my hobby, I just love investigating ideas. I still get up every morning and I got ideas in my head. I want to go downstairs and look at them, and a lot of them don't go anywhere, as you know, any analyst does, but some of them do, and I just couldn't quite stop doing that, and I finally decided, I might as well just write a few of these up and send them out. So that's kind of all I did, and my whole goal when I started was just to cover my Bloomberg cost.
There you go.
So then I could tell my wife I got a cash flow hobby. So that's kind of why. But I've just always loved looking for edges and opportunities, and in the markets and the economy a little bit. And I still enjoy it. As you guys know, if you've been in the business for any time at all, what you find out as you go along is how much you don't know, and how much what you used to know changes on you and no longer works. And it just is a constant puzzle that is endlessly, it's got layers of the onion you got to keep peeling. And it's just fascinating to me. And it still is after 40 years.
Well, that's awesome. I agree. Yeah, I've done this for over 2 decades. Absolutely. And every day You wake up and realize, oh, I didn't know that one. But one thing I didn't know, Jim, we'll just start. I mean, I love this recent piece. You talked about the tush push. People who probably know that in football, you line up behind the quarterback, you shove the quarterback a yard or two. It's kind of like a cheat play, so to speak. You said the stock market's been using the tush push for decades. Talk to us a little bit about that. I love this analogy.
I'm glad Ryan explained what that is, because I wouldn't have known what that is, by the way.
Well, the Philadelphia Eagles are probably the ones most recently known. It's been around forever, but basically, if you're 4th and 1 on the goal line, you put a bunch of beefy linemen in the backfield, hike the ball in a quarterback sneak, and essentially those beefy linemen just come up and push the tush of the quarterback over the goal line. And I guess I watched my Minnesota Gophers use that last Saturday to beat USC.
Oh, congrats! That's true.
Yeah, number 11 ranked USC, which at the end of the game, and then it just got me thinking that that's basically what the stock market does. And so, what rather than using beefy linemen, they use beefy policies. And I think one of the things that's underappreciated currently is just how much positive force we have behind this stock market, and it's lined up behind it. That's pushing its tush higher. Um, Normally 2 years into a bull, you got the Fed talking about, well, I guess it's time to start tightening a little bit, worried about overheat conditions. And you got policies moving away from supporting the economy and the stock market towards, worrying about inflation. We're the opposite of that because of the Fed's totally backwards approach to this cycle. Up until the Fed eased, a couple weeks ago, this was the only bull in post-war history where the Fed had been tight in its entire existence. And now we're easing, which makes this look a lot like the start of a bull. When you start a bull, what you do is you line up all those beefy economic policies behind the stock market, and you're worried about a recession or what. So Fed is cutting rates, short rates, long bond yields are coming down, fiscal juice starts to expand, the money supply quickens, dollar comes down. All of these positive forces for economic growth, as well as you got the power of disinflation typically, and that sets off all those beefy policies behind you pushing the tush, sets off a remarkable rally in the stock market. Generally the start of a new bull that's a broad-based participatory bull usually. We didn't get that in this one. We got a very kind of disappointing bull during its first year, and one that was very narrow. And I think it's because we didn't have the traditional tush push with all the policies lined up behind the market. But now we are kind of getting it. Now, the last few weeks, it's kind of backed off a little bit because of concerns about no landing. But the reality still is, if you look here in the last year, what are we finally getting? We're getting the Fed now easing short. Long bond yields are down over the last several months. Money growth has been accelerating. Fiscal juice has gone from like 5.5 a year ago to 7.2 of GDP. The dollar's off a little bit. We still have disinflation. And what you're seeing is this market that keeps going up, surprising many people. And for the first time, it's got broader participation than we've ever had, which you normally get at the start of the bull, but we're getting 2 years later because the Fed is kind of 2 years tardy to the party. And that's kind of what I wrote about. What I did find interesting in the piece, though, Ryan, was surprising to me, was it wasn't even so much how strong these policies were, like if money growth was 10% versus 2%. It was more how many policies were supportive. So if you had really negative results, if you only had one positive policy or zero,
Okay.
but you had really positive results if you had 4 or 5 policies lined up behind the stock market, which I think we do today.
And that's the tush push, right? You put more people you put behind the quarterback and smash into the back of them. Although I guess you could argue, like you said, times change. The tush push is not working as well for the Eagles this year. I mean, a different center and things. And that's kind of what you said. The market always changes and things change. But no, I love that analogy. And I'll let Sonu come in a second. But I think that's what makes you so. I mean, listen, everybody, a lot of smart people out there. But can you communicate? Can you tell a story? And I just love the way you made that analogy between the tush push and the equity markets and the economy. That's great. So, no, go ahead.
Actually, no, that was fantastic. I have so many questions with respect to not about tuition, but on the fiscal policy side, we'll come to that. But just on broadening out, right? It seems like we're seeing broadening out across large caps, across sectors. But are we still yet to see that from a size perspective for small caps and mid caps to start participating in a much bigger way than they already have?
That's a great question. So, I wish I knew the answer to that. I thought
Us too, yeah.
I thought the answer is yes, but it hasn't. I mean, they're not doing horrible, but they aren't doing much. And I do think to me, one of the fascinating. I mean, to me, the three most fascinating pieces about where we're at today. One is the positive force I just talked about. One is the lack of vulnerabilities in the private sector, both the consumer and the business to recession. I just don't think there's a lot of vulnerabilities. And thirdly, to your point here, is what I think is behind a lot of this, is just this persistent lack of confidence among households and businesses. You got consumer sentiment, which is going to come out shortly here today, but it's been down at recession levels this entire expansion, really ever since the pandemic. And so has small business confidence, and even CEO confidence has kind of been in the tank. Just a persistent pessimism on Main Street that really hasn't ever existed after, a 4-year supposedly consistent economic recovery and a 2-year bull market. And I think that's a lot of what's behind the lack of broad participation, particularly for smaller caps, because we can't get animal spirits if we can't raise any confidence. And if you can't get animal spirits on Main Street, it's difficult to get the full effect of that on Wall Street as well. And if you think about it, the smalls, the lower qualities, a lot of these areas, IPOs, venture capital, a lot of those areas you go to only when you're really, really just ecstatic about the future. And you generally have most cycles that get to that point, but we haven't yet. And I think in part because for a host of reasons, confidence has been and continues to remain somewhat depressed. I personally think it's going to start to rise now more emphatically. It's picked up a little since evidence has leaked out the Fed's going to ease. I think they've been holding it back uncharacteristically. And then I think the election will help getting that out of the way. But if we do lift confidence yet in this thing, and by the way, bulls, if you look back historically to 1950, you just don't have a bear market, really, until confidence is at much higher levels on Main Street. And so we might have to do that to end this thing. And it could be it ends finally in a blow off when we finally get confidence on Main Street rising, we get animal spirit behaviors show up both on Wall and Main. But that's my.
Looks like we are far way away from that right now, right?
I think we are, although confidence can move quickly, right?
Sure.
But right now, you're right. I think we're a long ways away from that.
Jim, I have to be honest. I'm worried. You're doing a spaces. That might be a contrarian indicator by itself.
Oh, yeah, that's not a good sign. You're right.
I know.
Maybe people should call their broker right now and sell. I think you're right.
I don't know. I love that. I love that angle on confidence because you wrote another awesome piece just recently, and in a way, I think PE multiples are kind of confidence, right? PE multiples are higher, shows people are more confident. You did some amazing work on that, but also that E part of the PE. Talk to us about that. What you just wrote about.
Well, the thing about, and this gets really to the economy too, is that the problem we're dealing with just in recent days, to a little bit on this point, Ryan, is we're starting to see the darn economy, the soft landing went away. Now it's kind of no landing, right? We still got GDP now numbers that were, right now. I think it's 3.25% or something like that. It's a little coming in a little hot overall. But why is that? Why is that to some extent? It certainly can't be the Fed, because the Fed has been tightening, really since the middle of 2022. And why would the economy pick up really, when the Fed just started easing? I don't think they had much to do with it at all. The reason is because what I call laissez-faire policies out of the control of the government, including the Fed, those policies have been easing in the last year. And so, you look at the 10-year yield. A year ago it was about 470. It's now whatever it is, 410. You've got money growth. A year ago was -4%. Now it's +2. Fiscal juice, 5.5 to 7.2. The dollar 107 versus about 101, 102. Disinflation's going to come down even further. Maybe a percentage point. That's a lot of juice, policy-wise, coming at the economy. And what you're seeing is, guess what? The job market's not shutting down. Overall, the consumer's not shutting down. And with that, earnings aren't probably going to shut down. And if I lag what I call total policy stimulus, and I've used different variants of this over the years, but kind of taking fiscal juice as a percent of GDP plus monetary growth in the last year, minus the change in the 10-year yield over the last year. Sometimes I put the dollar in, sometimes I don't, and then lag that 12 months. And what you find is a pretty close relationship to the annual growth rate in S&P earnings. And right now, that total policy stimulus indicator 12 is suggesting in the next 12 months, earnings are going to be accelerating in terms of their growth rate. And if the other thing to put with that in the piece was almost all the time when the Fed eases short rates, PE multiples go higher. So we could be looking at something where we get a little higher valuations on top of higher earnings, which is kind of an oddity where you generally don't have those both together, except maybe at the start of a bull.
Now, I love that connection between, like, the economy and markets via profits, and then even the fiscal piece of it, right? And I will ask about elections. It's similar to how we wrote about this in our mid-year outlook too. It's similar to how we view things as well, like, the connection between the economy and markets being profits, and then profits being, attributable to households, business investment, but also fiscal policy, right? And how much is coming from that. Like, I'll put a thread on this maybe later today. It'll be interesting, I think, especially in light of what you just said. Like, corporate profits rising over the last 6 quarters, expected to rise in the future too. But so much of that has come from the fiscal side as well, because the government's pushing more money out.
Yeah, that's a
And
good point.
Ryan and I have continuously talked about even things like defense spending has been going up by a lot, right? And then this year, I think the next fiscal year, fiscal deficits are going to be like 1.8 trillion or something like that. So,
well, you guys have been on that, because I've seen the tweet regularly over the last, since I got on X, I guess, just saying, hey, look, Mark keeps going at Y. Well, look at this chart of forward earnings. They just keep going straight higher. It's a good chart.
Yeah, keep it simple.
Absolutely.
Yeah,
it's about profits at the end of the day, right?
It is.
Yeah. Talk about the election and what you see. What just continuing along that fiscal policy and election and beyond the election, really, into what you're looking for next year, especially since we have this big, Ryan and I were talking with our advisors yesterday on a morning call. Next year is going to be about tax policy. So much, right? There's going to be so much. It'll probably come out to the end of 2025, just before expiration. That's when Congress probably gets its act together. But I'm curious how you're thinking about that.
Well, I don't know. I've never been a big one on elections and government. I think more times than not, that kind of stuff leads you astray when you get too focused in on it. I understand there's big micro implications, and there very much sometimes are, and certainly could be. But normally, I think it creates a lot more emotion. We're all kind of emotional to those things than probably is needed, and maybe unhealthy amounts of it in many cases. I think our founding fathers, they left the country they were originated in because of a tyrant, and the last thing they wanted when they formed a new country was to have have anyone new in charge again. They didn't want anybody in charge. So they created this comical government structure where they put 450 people over here, they put 100 people over here, and they put one person in this White House. They say, if you guys agree on anything, let me know. Otherwise, we're going to let laissez-faire manage this thing. And typically, laissez-faire manages most of the time because they don't agree that often. And I think, to me, in this election, the margins are so thin that not only in the White House, but for the House and the Senate, that it's doubtful to me that either party gets substantial tri-power. Even if one party does get tri-power, it still will be difficult to pass much, and it's probably going to be a split power, in which case very little is going to get accomplished on anything. Is my belief, my best guess. Overall, I think you're better spent focusing on, the 330 million people that going about their own business every day, making their own decisions in their own private interest, and what that causes or what that drives. And, a lot of it's policies they're driving, like money growth, like yields, and those things to me are probably a better indication of where we're headed than getting down the rabbit hole a lot on election fallout impact. I do think it will be good to get past it, however it turns out, just to remove the negative impact on confidence. But I guess I'm hopeful that maybe that neither party gets much power and not much is done. Good luck.
Yeah.
Yeah,
No,
we've been in that camp too.
we have it well said. I mean, I think it's 13 years in a row where you have a split Congress. The S&P's higher. I mean, it could be random, maybe not. This year's going to be 14, right? So that's something to always remember. Jim, we want to be respectful of your time. I know I said maybe 20 minutes. We've already passed that. Maybe another 5 minutes or so. This is an awesome discussion. How can people kind of learn a little bit more about what you're up to? Where can they follow you? And then one other question. We work with financial advisors. Carson Group is a $38 billion RIA. We're in 42 states with almost 500 financial advisors. You've obviously worked with financial advisors for a long time. What's some advice that you can give a financial advisor, Jim, you've learned over the years, along with where people can learn more about what you're up to?
Well, they can go for as far as getting my stuff or whatever. They can go to Paulson. That's EN PaulsonPerspectives.substack.com. That's where my work is, and I think it's set up right now for a 30-day free trial, so you can do that, and after that, the pay comes up. But I think it's like $9 a month or $90 a year. So, and again, like I said, I'm just trying to cover some costs mainly. And I appreciate anyone that wants to come and read. That's part of the fun of it. So, welcome to do that. The advice. I think that to me, I take as much in as I can from guys like you, guys like me, others, and try to keep it diversified, so you're getting ideas from both sides of the street, bulls and bears alike. I think it's important not to close off people that don't have your gut feel. But at the end of the day, I think it's important, if you're running your own thing, to run your own thing. And that is to say, at the end of the day, don't just tie your horse to any one cart. I take it all in, use it, but make your own decisions with your clients, and what you think is likely to be the best, and also maybe what's best for them. And I think I'd be managing more kind of two things, I guess. I don't know if this is right or wrong, but I'd be managing their sort of emotion, if I can, to some degree, understanding where that's at, and understanding how much you can maybe get them to take risk within the confines of if you make them take too much, they may just come out entirely at the wrong time to really screw themselves up. And so I think you got to take that into consideration, and then try to set them up so that you can get them through the rough times, so that they can succeed with the value of capitalism over time. But I think I would never give up my right to make my own decision and not just tie to some individual's, system, if you will. Overall, that'd be my advice.
Oh, that sounds awesome. Which part of the world? Don't have to give your exact address, but where are you located now, Jim? Where are you living now?
Well, I've been in. I grew up in Iowa.
Yep.
In a small farm town in Iowa, and I went to Iowa State, which at the time my academic research was it was the farthest away from home state school.
Okay.
So
Yep.
that worked out. And we were down there for a number of years, and then we've been up here in Minnesota now for 25 years or whatever it's been.
That's what I thought. So next time I'm in Minnesota, maybe I'll hit you up. Maybe we can hang out. I thought you were in Minnesota. Absolutely. Well, Sonu, we probably got time for like one more each, and then we probably got to go. One more, Sonu. Make it good.
Yeah, no. So you mentioned diversification, and are you still? And I know, circling back to what I first asked about that broadening out, you still like small caps and mid caps in this market? You think confidence will increase?
Yeah, I do. But I've already been disappointed in that view for a little while here. so, but I'm kind of still there. I'd have a little bit of both in the portfolio. As far as I like the industrials and the consumer discretionary probably really well, and but I also like high dividend yield because I think a lot of those money funds, $6.5 trillion, come out. They're going to go looking for yield, and then I also like low quality over high quality because I think economy is going to do better than people think here, and they've been kind of beat up, and I think that they could have a period. But then when you get beyond that, I do like the small mid cap tilt. And I wouldn't abandon, the Mag 7 or the tech era. I just think I would underweight that for a while, as I think we get some play in these other areas. And I wouldn't necessarily overlook international either. It's been dead for so long, we hardly even think about it anymore. But, particularly EMX China, I still think make a little sense. But the EMX China and the small mid have been really difficult for so long. But I'm still kind of there. Yeah.
That's awesome. Thank you so much, Jim.
You bet.
Yeah, a lot of our views definitely jive, I think is what I'll say, Jim. We are about 30 minutes or so we want to probably wrap this up. I do just want to, again, thank you so much, Jim, for everything you've done for our industry, for so many people, because you've been on TV for so long, and it's just, I just watch you, and I'm like, well, he's usually right. Like, you're usually right. Like, these are the type of people I like to follow. I look up to, and I've honestly, one more thing, I'll let you finish it. I mean, you truly are someone that I've lived up to my whole career. And I know so many other strategists who've come up. I get this now. People look at me like I looked at you 20 years ago, which I don't know if that's weird or not. But, I learned it from you, right? I learned how to react and how to treat people and how to act in public and how to do research and so much. I just kind of watch from afar from you. And I just really genuinely want to thank you, Jim, for everything you've done. And I'll give you the final words. Thank you so much, Jim.
Well, I just want to thank both you, Ryan, and Sonia, for having me. It's really fun. It's I don't do as much of this anymore, but it's fun when I do, and I really appreciate the invite and like I said, bringing me into the new era to figure this out this morning. I think you guys are doing it right as well. It hasn't escaped my attention even before I retired, Ryan, how you went about your stuff. I've always thought you did it really, really well, and you continue to do that as I see you on X and whatnot too. So it's an honor and a privilege here to let an old guy get out some thoughts. I really appreciate it. Thanks so much.
We do too, Jim.
Absolutely.
Thank you so much.
You.
Now, the bad news, we'll probably invite you back in about 6 months or so. So now we know how this works. So just, we might do it again. We might do it again in 6 months or so if you want, Jim. But with all that, thank you, Jim Paulson, for joining us. Thanks, Sonu. Thanks to all the listeners of 15 Minutes to the Bell Spaces. Sonu and I don't know if we'll do one next Friday, Sonu, because you and I are together in Cincinnati. Maybe we will.
Yeah.
We'll let everybody know. We might do one next week, maybe a different day. But I know there's some big names at this event we're going to in Cincinnati next week. We might just snag someone and do a random Spaces at some random time next Thursday. I got a couple people I'm looking at, so who knows? Follow us on X.
You got to show me around. So
exactly. Yeah, Jim, come to Cincinnati. Come to Cincinnati next Thursday, Jim. We're all in Cincinnati. Right. It's a party. Right. It's a party. All right. Take care, everyone. Have a great Friday. Thanks again, Jim. We'll talk soon. Bye, everybody.
Bye-bye.